Cost segregation is not a tax trick. It is a highly regulated engineering and accounting discipline defined by the IRS Audit Techniques Guide. Today we're doing a 10-minute technical masterclass on how to legally maximize your cash flow using the 2025 restoration of 100% bonus depreciation. No fluff, just the raw data and IRS regulations you need to scale your portfolio. To withstand an audit, your study must follow the IRS Cost Segregation Audit Techniques Guide. The U.S. Tax Court has repeatedly ruled that a desktop estimate or a CPA's rule of thumb percentage is not defensible. You need a report based on recognized costing manuals and physical inspections that justify why specific plumbing, electrical, and finish components qualify for accelerated recovery under Sections 1245 and 1250. The study reclassifies assets into Section 1245 personal property, typically 5 or 7 year lives, and Section 1250 land improvements, which carry a 15-year life. We're identifying assets like decorative millwork, dedicated data cabling for servers, and specialty HVAC systems that serve specific equipment rather than the building's overall environmental comfort. For land improvements, we analyze drainage systems, parking lot lighting, and site utilities. Before the study even begins, we must determine the depreciable basis. This requires a professional allocation between land, which is non-depreciable, and the building itself. We look at property tax assessments and independent appraisals to ensure your starting number is defensible. If your land-to-building ratio is off, the entire cost segregation benefit is at risk during an audit. You cannot simply assume a generic 80-20 split. The One Big Beautiful Bill Act of 2025 permanently restored 100% bonus depreciation for property placed in service after January 19th. This effectively bypasses the multi-year recovery periods for these reclassified assets, allowing a full write-off of their remaining basis in the very first year. This is a massive timing benefit that significantly increases your internal rate of return by front-loading deductions. Consider a $500,000 rental. An engineering study reclassifying 25% or $125,000 results in an immediate tax saving of over $43,000 for an investor in the 35% bracket. The time value of money here is undeniable. You are taking today's dollars to reinvest, rather than waiting 27 years for a nominal deduction. The internal rate of return on the engineering fee alone is off the charts. If you bought years ago and never did a study, you can perform a look-back study. The IRS allows you to take all the depreciation you missed since the date of purchase as a single Section 481A adjustment on your current tax return. This catch-up mechanism is incredibly powerful for seasoned portfolios that have been sitting on untapped equity. You are literally recapturing lost cash flow from years past in a single filing. You file this using Form 3115. It's an automatic change in accounting method. You don't have to amend past returns. You simply claim the entire missed amount as a one-time deduction to wipe out your current year income. It is one of the few ways to travel back in time for tax savings without red flagging old filings. This requires a professional to ensure the codes are cited correctly to avoid an IRS rejection. A critical technicality: state tax decoupling. Not all states follow federal bonus depreciation rules. While Florida is investor-friendly and generally follows federal law, states like California and New York decouple, meaning you may get a 100% bonus at the federal level but still have to depreciate normally for state taxes. You must calculate the SALT, state and local tax, impact to see your true net benefit. This is why location matters for your tax strategy. You must account for depreciation recapture. When you sell, the IRS recaptures that accelerated depreciation at ordinary income rates capped at 25%. This is why cost segregation works best for long-term holds or investors using a 1031 exchange to defer the gain and keep the depreciation benefit working in a new asset. If you are flipping in 2 years, the recapture will likely negate the benefit of the study. Rental real estate is per se passive under Section 469. Unless you qualify as a real estate professional, your cost seg deductions can generally only offset other passive income. If your modified adjusted gross income exceeds $150,000, these losses are suspended and carried forward until you have passive income to offset. These suspended losses are still an asset on your balance sheet, even if you can't use them today. To break the passive loss barrier, you need real estate professional status. This requires two things. First, you must spend 750 hours a year in real property trades or businesses. Second, that time must represent more than half of your total personal services performed in all businesses for the year. Contemporaneous logs are your only defense for this status. The IRS scrutinizes this heavily, so you must be meticulous in your record keeping. Beyond reps, you must materially participate in each activity. There are 7 tests. The standard is 500 hours, but you can also qualify with just 100 hours if your involvement is more than any other single person. For couples, only one spouse needs to qualify for reps to allow the entire household to use these deductions against W-2 income. This is a powerful strategy for high-earning medical or legal professionals with a spouse managing the portfolio. If you can't hit the 750 hours, the short-term rental loophole is the alternative. If the average guest stay is 7 days or less, it's not a rental activity under Section 469. You still need material participation, often just 100 hours, but you bypass reps entirely, letting you offset your W-2 income directly. This has become the primary tax strategy for high-earning W-2 employees building a real estate portfolio. Partial asset disposition, or PAD, allows you to write off the remaining basis of an old component when you replace it. If you put on a new roof, you can take a terminal loss on the old one. Without a cost-seg study to establish the value of that original roof, you are forced to keep depreciating an asset that is currently in a dumpster. PAD turns a necessary renovation into a significant immediate tax event. You must capture this in the year the replacement occurs. For commercial assets, we layer in Section 179D energy deductions and qualified improvement property rules. QIP has a 15-year recovery period, making it eligible for the 100% bonus depreciation. Layering these with a cost-seg study creates a nearly complete wipeout of taxable income for high renovation years. Under the new laws, the 179D deduction has increased significantly for those meeting specific efficiency and wage requirements. Finally, the long-term play. Step up in basis. If you hold these properties until death, your heirs get a stepped-up basis to fair market value, effectively eliminating all the accumulated depreciation, recapture tax forever. It is the ultimate method for passing untaxed equity to the next generation in a legal, permanent way. This is the foundation of multi-generational real estate wealth. Buy, borrow, and die without ever triggering the recapture tax. Safety is paramount. The IRS looks for engineer-based credentials and physical site visit logs in the final report. Ideally, your study provider should be a member of the American Society of Cost Segregation Professionals. Do not accept a desktop study for a high-value asset. A defensible engineering report is your only real shield in a tax audit. If the provider doesn't stand behind their report in an audit with a written guarantee, you should walk away. I'm Tony Damiano from eXp Realty, specializing in the investment markets of Tampa Bay and Central Florida. Cost segregation is not generic. It must be tailored to your specific tax profile and long-term exit strategy. Contact me today for a technical feasibility analysis. Let's ensure your portfolio is operating at peak tax efficiency and that you're not paying a dime more than you legally owe. I'll see you on the next one.